Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
About 4.7 million homes sold in the U.S. in 2024. Does that sound like a dead market to you? Doesn't sound like one to me. Yeah, home sales total is down, but 4.7 million homes is a lot of homes. On the show today is James White of Total Expert, which provides tools to help credit unions more efficiently close mortgages. What Total Expert offers is a powerful CRM for loan officers, automates much of the process. White gives the details in the show. Also on the show is Zachary Short, Vice President of Mortgage Production at Utah Community Credit Union with assets over $3 billion. That's a big credit union, but as Short admits, they're competing with other bigger credit unions and big banks and you name it. Utah is a very competitive market. But UCCU is committed to the mortgage marketplace, and Short's team satisfied users of the Total Expert tools, and he tells why. Message of this episode is plain. Although some institutions have walked away from the mortgage business, others like UCCU are prospering because they know homes are still selling and people need mortgages. Listen up. So what's the state of the market right now? I know it's a year ago, it was essentially dead. What's it today?
From my perspective, it's still a very interesting time because everyone's really watching to see how the dust settles with all of the political changes that are going on. So we haven't seen a tremendous amount of impact to the Treasury market, which is what actually drives mortgage rates, even though we've seen the Fed fund rates go down. And I think a lot of that just has to do with the overall concern or inability to really forecast what's going to happen. So it is a very interesting time. So there is a company out there that primarily does research and analytics for credit unions by the name of Radin Financial. And they just did a national research study talking about lending. And so they reached out to a number of consumers. And the number of consumers that are looking to obtain a loan in the next 12 months has really increased, pretty dramatically in comparison to previous years. But it's really going to come down to how the dust settles with the economy.
And you were, if my memory is right, president of that company a few years ago. That
is correct. Yep.
Yeah, I think it's the uncertainty is weird. We're really in a period of great uncertainty, but it could resolve at any time. It's a fast-moving world right now, too.
I could not agree more. So I would predict. This is just my personal prediction, but. Give it about 3 more months and, we'll know, the direction that everything's going and be able to see the dust settle and really understand, where rates are going to land, for this year.
I live in Phoenix and the real estate market is certainly slow here, but what's also happening is that apartment rents are going way up. Things that were like $1,200 6 years ago are asking $2,000 a month. And to someone in New York or San Francisco, $2,000 sounds like pocket change. But in Phoenix, that's big money. And these were $1,200 a month apartments. They're perfectly nice. But at $2,000, why don't you just buy a house if you can?
No, I agree. Well, and even just if you look at the average consumer, we have more consumer debt than we've ever had. As a nation, and then housing prices or living, expenses, whether it be rent or home, it has increased dramatically as well. I mean, we're really at an interesting place, from an expenses perspective, because we can't continue to live off of this consumer debt that we've, built up over the past couple of years.
I think the scariest thing, and this has to affect the mortgage market, is the escalation in new car prices, where like 40 or 50,000 is becoming sort of, oh, that's a normal sort of car. That's not a fancy car anymore.
I agree. We just bought a new car as a family, and it's a nice car. It's an Acura, but I could not believe how much we had to pay for it. Back in my day, you could have bought a home for the same price as we paid for this car.
Yeah, no, we bought a BMW like 6 years ago. And yes, my parents' the last home they bought cost less than half of what that BMW cost.
Mm-hmm.
I mean, yeah, car prices have just gone crazy. Are the interest rates still holding people back from buying?
It is interesting because I do believe that interest rates were holding back car purchases, and they were the average consumer was keeping a car longer before they would typically replace. But there's a lot of research out there that shows that credit unions specifically are going to be hyper focused on auto lending. I think it was something like 77% of credit unions have stated that auto lending will be their primary focus from a lending perspective in 2025. So I don't know if they're counting on the people having to replace automobiles that they have been holding on to, or if it's counting on the Fed funds rate impacting auto loans.
Zachary, how's what James saying sit for you in Utah? Does it sound accurate? Do you disagree?
No, I think it's accurate. One point, though, with the rent versus owning here in Utah, though, that's kind of interesting is renting is quite less than owning right now. And so that's part of what's discouraging some of the home buyership here. I don't think it's necessarily a rate that's driving them away. It's really just comes down to the payment is what we're really seeing. And so that's where we see a lot of, the builders, and, we've even got programs that we put together to, do temporary buy downs or permanent buy downs to get the payment more affordable for the member. And we find that is the most successful way to approach this market, because everybody's really concerned about what the payment is more than they are the rate. And we're seeing that with cars too. People are conscious about adding, $400 or $500 a month to their budget for a car. But we're also finding that a lot of them are kind of due for that upgrade cycle right now. And so that's where autos are definitely in focus right now. But yeah, the only thing I would probably say is I think it's more payment than rate at this point. I think a lot of our members have come accustomed to some of the rates now. Anytime it ticks above 7, I think people kind of pull back and pause for a minute. But as long as we stay in the 6s, then it kind of more comes down to just, what's the payment going to be?
I think in the car business, and I've had friends who are car salesmen, they don't ever talk about rate. They talk about what's the monthly payment. Can you afford $399 a month? Can you afford $499 a month? Yeah, the interest rate could be 0 or it could be 14%. People don't tend to ask with cars. With houses, they do.
Yeah, definitely.
Now, is the duration? Car loans have extended. 7-year car loans are pretty common now. Mortgages, has that extended?
Yeah, in fact, we do very few 15-year loans anymore. Almost everything's a 30-year now. Even just 5-6 years ago, you were still getting a pretty good, lower term business, but it seems like everything's a longer term now. And you're seeing that a lot on the cars too. Everybody's going for the longer terms, even though the rate could be slightly higher. It might help them fit it in their budget better. And yeah, I just see that payment as being more of the driving factor right now.
Do you go beyond 30 on a home loan?
We do not. We don't offer any 40 years here. But so 30 is our max term right now.
Occasionally I hear about 40, but I don't think that's a common instrument.
Yeah, those longer term loans like that are very difficult to portfolio, because now you're locking into that rate for a long time in the portfolio. So those are the exception. But to your point, Robert, over the next few years, I could see them becoming more common because, to Zachary's point, the average consumer isn't as financially healthy as they should be, and they aren't as financially aware of, the impact of, of how those rates impact. All they really care about is the monthly payment. And so, as home prices continue to increase because inventory and building costs increase, I could see where we're going to start to extend some of those terms just to be able to help people afford to buy a home.
Now, before you signed on, James, Zachary told me an interesting thing, many of which he told me I won't tell you because it'll upset you. Actually, I'm kidding you, but he told me an interesting thing, which is that the Utah market is highly competitive. The buyers are rate shoppers. They will hit all of the leading institutions before signing on the dotted line. How can you help Zachary succeed in that environment?
Well, we definitely can. So, at Total Expert, we have this module that is extremely popular right now called Member Intelligence. And what Member Intelligence does is it tracks your current customers or your past customers, both for mortgage. We can also do it around your retail banking customers as well. And we look for different types of aspects. One of them is, are they cheating on you? Have they pulled their credit with another lender? So that can help while they're rate shopping. That can also help you retain a previous borrower that perhaps did not reach out to you, or existing borrower perhaps didn't reach out to you when they started shopping. So being able to take those types of alerts plus life events, major life indicators. There's a number of different alerts that we offer MLS posting. So if your existing customer or previous customer puts their house on the MLS for sale, it would notify the lender so that they can reach out and try to win that business.
I like the idea of notification that a member has just had his credit pulled at Rocket Mortgage, for instance. Now, Rocket Mortgage moves pretty fast. It's but it would be good to get an alert that this is in motion. And then what does the institution do?
Yeah, so the first thing that the institution needs to do is have the loan officer reach out to the borrower. Now, especially with regards to credit unions have a tremendous amount more trust, with their members than, the average institution. So being able to reach out, you do obviously have to position it properly. You can't have a loan officer reach out and say, "Hey, I noticed you're cheating on me," but being able to reach out. And then the other thing we do is kick in with automation marketing as follow-up as well, just in case that loan officer doesn't connect with them, with that prospective borrower or current borrower. Then you can start with some automation marketing that is just promoting the services around mortgage that you will offer, like, to Zachary's point earlier around buy downs, and, being able to, not everybody offers buy downs. And so being able to have, buy downs or relationships with builders or realtors and things like that. So there are values that you can bring. A lot of institutions will also offer relationship pricing, where if you have a mortgage, you can save on your auto loan, or get a better rate on your CD, those types of things. So.
And Zachary, would you contact a member who had just had his credit pulled by Rocket Mortgage, asking what the heck's going on, or something to that effect?
Yeah, we are utilizing Total Experts CI capabilities there. And so the way that we do it here at UCCU is we are monitoring the payoffs on top of that too, because a lot of these loans are with us already. And so we get the payoff alert if somebody's trying to pay the loan off. We have a loan officer follow up there. If somebody pulls their credit, our loan officers are reaching out. We got some automated communication going out with it as well to try to get in front of the member. But like to your point, especially these online lenders, like a Rocket, since you brought them up, Actually, they're kind of one I like when that comes up because the way that their process kind of, is a little impersonal. We find it a big opportunity because as a credit union, we have that personal touch, that local touch that they don't provide. And so, those are ones that you can really steal away pretty easily if you know that they're actually shopping you, though.
Right. And you can match the rate, I'm sure.
Yeah, but not only that, we can provide a much better local personalized service that they like too. They like the idea of making their payments to us locally, coming into a branch, right down the street from them and meeting with us face to face. Those are just things that the big online lenders just don't offer.
Now, James, you said that the data says that credit unions are going to really put an emphasis on cars. What are you doing to help them with mortgages? And are they that interested in mortgages right now?
Yes, so it really comes down to the credit union. So some credit unions offer mortgage just as a service to their members. So they're really not getting up every day trying to drive more mortgage volume. Other institutions like UCCU it's a major strategic driver for them and a great way to lend out money. So with those credit unions, we really are able to help them to separate themselves from their competitors and be able to compete with the Rockets of the world because we can provide technology and automation and those alerts so that they can stay on top of those prospective borrowers. So it's really about the first thing we do is look at the overall business model of the credit union, determine if mortgage is a strategic lever for them before we engage.
Now, what's currently your smallest credit union? You don't have to mention the name unless you want to. And what's the biggest by asset size?
Yeah, so the largest or the smallest credit union is a credit union in Rainbow City, Alabama. I won't say the name, but it's about 250 million in assets. And the largest credit union is PenFed.
So that's quite a range.
Yeah, it really comes down to the strategic focus of the credit union. So it really does not have to do as much with size as it does what are the strategic levers that they're pulling. It's kind of crazy, but one of the simple ways that you can tell is if a credit union has more loan officers than they have branches. So if they have a loan officer assigned to every branch, then typically, or less, then typically they aren't strategically focused on mortgage lending. They're just offering that service to their members as they come into the branch.
Now, what do you currently see as hot lending opportunities beyond mortgages?
It's always a balancing act with trying to balance the portfolio. And right now, HELOCs are still a tremendous opportunity for credit unions because there's so much consumer debt out there. I think it's 1.2 or $3 trillion that's out there that is high interest. And so being able to, because home prices have skyrocketed, there is a tremendous amount of equity there that can be obtained that can overall reduce the monthly payment, just as Zachary is talking about, or the monthly debt load that the average consumer or member has. So HELOCs are a real good way for a credit union to try to help their members stay financially healthy.
Also, at least in Phoenix, as people are staying in their houses longer than they perhaps anticipated, they're doing much more ambitious renovation projects on their houses, many of which would help if they could get a HELOC to fund it.
I agree. I mean, I'm one of those examples. So our children are teenagers about to go to college, and we were going to downsize. And instead, because home prices are so high, we remodeled a number of rooms in our home to try to help everybody feel more comfortable staying longer.
As I say, I just see people adding space on their homes, redoing that bathroom that you've always hated, but you figured, heck, we're going to move next year anyway. Why bother? But now you're saying, no, we're probably not going to move next year, so let's take the plunge.
I agree completely. And so HELOCs have really been popular since about, I'd say, about this time last year, maybe a little bit before, but they're still going strong. So HELOC is an area where a lot of institutions, bank and credit union, are using to make up the gap for any type of shortfall that they may have on the mortgage side. A lot of credit unions are still having very, very strong mortgage production. It really is a lot around what their business model is, and did they rely a tremendous amount on refis, or were they relying on purchase business? And if they had been relying solely on purchase business or primarily on purchase business, then they're still seeing good volumes there. Others who relied on refis are having to try to fill that gap.
I think that's one of your most important messages. And you had that same message when we talked last time when Canvas Credit Union was on, that a lot of people think that the home mortgage market is dead. Every credit union has fired all of their loan officers. And it's just, let's not even talk about it. And one of the messages in that Canvas Credit Union podcast was that, au contraire, there's a handful of, more than a handful, there are credit unions that are still making the mortgage marketplace work for them and their members. They're still doing business. It's what's your attitude? Do you think there's business there, or don't you? And if you don't think there's business, you're not going to pursue it.
Yeah, absolutely. And it's not as easy as it used to be, where you just open the doors and people flood in to obtain mortgages. But there's a lot of business still out there. You just have to work for it and get back to those fundamentals that we had to leverage before. We had free money for so long.
Well, money's not that expensive right now. I'm not saying it's cheap, but in my lifetime, this is not expensive money.
I agree. My first home, I think, was in the mid sixes, and it wasn't that long ago. And we were ecstatic to have it in the mid sixes. So,
yeah, I bought a house in 2004, 6.75 interest rate. And that was pretty good for the time. Didn't complain. Yeah. It's so now when people are whining at 7%, it's like, that's not so bad. In my lifetime, I've seen much higher rates, twice as high, actually. The credit union just has to be optimistic. Zachary, what keeps you optimistic?
I've been doing this a long time now, and I've seen the cycles in this industry, and there's money to be made in every cycle. You just got to know where to go for it. And like James was saying, is if you focused on refis only, yeah, you're not doing very well right now. But here at UCCU, we've always been very well rounded. In fact, I still have all my top producers. They're still producing great. We've got builder relationships, we've got realtor relationships. And, those are the things that really make you the money all the time. The refis are just kind of the icing on the cake. When you get those big refi booms, you take advantage of them, but that's not the core of your business. If it is, then you're going to just have all these boom and busts. And so that just hasn't been, the main area of focus for us, at least, in the last, several years too. Like right now, we had a sales training this morning, and the message is, get out there, build your foundation for the year. This is the time of year that you're talking to builders and realtors. And even though home sales are down right now for the year, as soon as the sun comes out and people start moving and looking to buy for homes, you want to be in front of those realtors and builders early. And so a lot of us get kind of down on ourselves right now this time of year instead of, building that foundation. So
you're actually making contact with trying to build relationships with realtors. Is that common?
I would say probably not so much for credit unions. I would say a lot of the credit unions generally are kind of that in-branch, just service the member kind of approach. I try to think of us here that we're, a little bit more like the IMBs, but within a credit union. We try to think more like an independent. We try to do business more like an independent, but we also have the financial backing and support of a credit union and our member base. And so I feel like we have the best of both worlds that way.
Yeah, is it easy for you to hire loan officers?
Yeah, it's been very easy. I haven't had any problems with that at all.
So in other words, the people out there aren't saying, oh, this is a slow market, I don't want to go in it.
I would say a lot of them are wanting to come work for me because I know I've got so many leads. I've got 230,000 members I can farm. And so, like to James's point earlier about consumer intelligence, there's lots of things you can do with that member data to find the opportunities that you can't do otherwise. And on top of that, we've got a lot of, insight into their financials, so we can help them out and hopefully get in front of them when they have those life-changing events early on.
Now, James,
Yeah.
are you offering your customers new services? Are you putting emphasis on different products that you're selling customers?
I would say in the mortgage industry, there is more focus, right now on ARMs as an example to help buyers keep their monthly payment down. There's more focus on buy downs, as Zachary mentioned as well. So there it does shift according to what product is going to resonate with the consumer or the prospective borrower. The one thing I was going to add too on recruiting that you mentioned earlier, recruiting has been a big thing for mortgage organizations for the past, I'd say, 12 to 18 months. And a lot of it has to do with those IMBs who solely focus on mortgage. When mortgage is down, a lot of them struggle. And so a lot of the best loan officers are moving around a lot. And so it's a great opportunity for someone like Zachary who has a stable opportunity with a lot of leads that can be funneled to that loan officer to be able to pick up some of those better salespeople.
Are they institutions you're working with? Are they still primarily securitizing their mortgages, packaging them, selling them off?
Not at all. So um, IMBs for the most part do that for sure. I mean, some of them portfolio, but not a lot. From a bank and credit union perspective, it's usually a mix. A lot of banks will package and sell the conventional mortgages and save their portfolio room for jumbos and construction loans, more creative type loans. And then on the credit union side, the vast majority of them portfolio all of their mortgages. Now, there are some credit unions out there that'll sell to Fannie and Freddie a little bit, but for the most part, they're keeping them in house.
NCUA can get a little antsy about overconcentration in a portfolio. So if you're in Utah and you primarily do Utah mortgages, NCUA might look at that saying you're over dependent on Utah. So if the state of Utah goes into an economic bust, you're in a mess.
Yeah, and someone like Zachary, they offset that with small business lending, member business lending, and some of these other items, consumer lending, whether that be HELOCs or line of credits, credit cards, auto loans to even out that portfolio. Because to your point, the NCUA does get very antsy, not just in the overall portfolio, but concentrations in the portfolio of certain types of member business lending loans, or too many jumbo mortgages, or things like that.
So Zachary, do you have any issues around that stuff?
No, we don't. We're pretty well balanced. We've got a very good board of directors here and a good executive team that keeps a lot of that in check for us. We do sell the majority of our mortgages right now to Fannie and Freddie directly. We do portfolio quite a bit as well. But yeah, in order to keep those concentrations in line, we do sell quite a bit of it because we definitely lend more than we have for deposits. And the only way to keep doing that is you got to sell some of them. But when we sell them, we still retain the servicing. So our members make the payments to us. We retain the relationship. But then that's what allows us to keep the lending machine going and not have to slow it down when you have any kind of concentration or loan to share concerns.
There are now, I noticed there's a number of QSOs that have been spun up by credit unions as well that allow credit unions to sell mortgages, or either sell them holistically or sell them as participations, and get other credit unions to buy into some of that to help balance the portfolio.
That's the jumbo, particularly jumbos.
Yeah.
It's so if you're a small credit union in Alabama and someone comes in and says, I want to buy this house. We all agree it's worth $2 million. Can you do that mortgage? The answer is going to be no way, Jose. No way. But if you could securitize that and get 10 other credit unions to participate. I mean, I've talked with credit unions so small that they would not finance expensive cars. It was just too imbalance in the portfolio. If you wanted a Hyundai, sure. But if you wanted a top of the line Tesla, Cybertruck, forget about it. We're not going to touch that paper. But with this fractional participation, that's a great opportunity for everybody to get into the game. Yeah. So James, what haven't we discussed so far?
Well, the one big thing that we haven't discussed, I think Zachary has implied it a couple of times, but at the end of the day, it's really about relationships, and technology can help support that and can help, maintain relationships at scale, but it's still about relationships, whether it's built with builders or real estate agents or the individual members themselves. Most of the time when people purchase a home, that's going to be the largest financial transaction of their lives. And, having somebody that they trust on the other side of the desk is important. And you can use things like consumer intelligence to help, prod you, to know when to reach out. But at the end of the day, it's still just a balance between the human connection and technology. It's just to Zachary's point with Rocket, technology can only get you so far. It's got to be a balance. And that's really what's important, especially with credit unions. I mean, I always say credit unions, it's their responsibility to keep their members financially healthy and sound. And if they believe in their products and services, then they're not selling. They're ensuring that their members are staying financially healthy by leveraging the products that are best for them.
Zachary, if I'm a member at your credit union and I call you up and I say, hey, I found this house, I want to buy it. Let's get the mortgage in motion. How long would it take you to fund that deal?
Yeah, not very long at all. We pride ourselves on our speed to service on purchase loans, especially. In fact, I've got goal matrix in my department around it where 80% of our loans need to be clear to close within 21 days or less. And we do exceed that goal. We are achieving it. And so a 3-week close is just normal for us. But every once in a while, you get that contract that needs to be closed in 10 days. And, we can accommodate that as well. Every area, we hold to a 24-hour turn time. Sometimes you get out to 48, but all of that is still doable to, meet those 10-day deadlines when you need to.
And I assume you benchmark yourself against your prime competitors on speed too.
Yeah. And where our market is pretty demanding that way, we pre-approve all of our borrowers up front. So that way our real estate partners can go out and be confident in the offers they're making that those loans are going to close. And, that really helps in your reputation in the marketplace too. If somebody gets a pre-approval letter and they see UCCU on it, they know that's gold. If that's got somebody else on it that doesn't do the due diligence we're doing, you might not get your offer accepted. So for us, we take it very serious and try to get a lot of that out of the way up front too, just to make it quicker down the road.
What does James and his group do for you
that
you like having someone else do it rather than doing it in-house?
Yeah, so I've got a lot of loan officers that are very high producing loan officers. And frankly, they don't have time to send emails and text messages and stuff all the time for updates. So we've really leveraged Total Expert to take that heavy lifting off the loan officers, monitor some of these opportunities that we have. So really create the automation. So my approach to Total Expert has been, I've been wanting to build the automation around to where if my loan officer never logs into it, it still has tremendous value to everybody, to the member, the realtors, everybody. So that way everybody's fully engaged and receives the information and the updates they need in a timely manner.
Cool.
So logs into the system, then they just get that much more benefit out of it with the flyers and the marketing opportunities and such. But we've built so much automation around it that it just really takes that heavy lifting off the loan officer so they can go out and find that next deal.
So, the loan officer kind of focus on what is really, really important to his or her personal bottom line and the institution's bottom line.
Yeah,
Whereas
exactly.
James is doing all the other stuff that's important in closing the deal, etc. But it seems distracting if what you're trying to do is close a lead.
Yeah.
Did I misrepresent anything you're doing, James?
I don't think so.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.